Good evening, and welcome to Ironwood's Quarterly Market Insights webinar. Thank you all for taking the time to join us tonight. My name is Preston Morris, Portfolio Administrator here at Ironwood. It is my pleasure to introduce our speaker, Rex Weeks, Chief Investment Officer at Ironwood Wealth Management and Chartered Financial Analyst. Rex has a comprehensive agenda to walk through tonight, so we encourage you to submit your questions via the GoToMeeting chat box at any time. We will reserve time at the end of the presentation to address them. Rex, I'll turn the floor over to you.
Thanks, Preston, and thanks everyone again for joining us tonight. Like Preston said, as always, a lot to get through, so we'll try to be not too quick, try to get through all the details, and then, like you said, leave time at the end, hopefully to get, if there are any questions, to get them all answered. The agenda for tonight, so we'll start with the economic data that came in the last quarter of 2025. It's a little sporadic with the government shutdown that we experienced, but we'll try to piece it all together. We'll cover GDP and the consumer, national debt, the buzzword of the last couple of years, AI spending, the Fed, inflation, interest rates, and then we'll finish off with earnings and valuations and what it all means. So Q4 2025 economic data. The 10-year Treasury rate currently sits at 4.28%. We'll dive in a little more detail on that later, but it's actually above where it was last time that we had a full webinar on the economic data. Both ISM manufacturing and non-manufacturing or services are both in expansion toward territory for the first time in 12 months. We continue to see weak job numbers from the data that we have received from the Bureau of Labor Statistics, and the unemployment rate has remained stable. Real GDP growth of 4.4% in Q3 of 2025, continuing the reversal of the trend we saw in Q1 with some of the front loading of the imports when Trump announced the tariffs. And then Atlanta GDP now is forecasting 4.2% growth for Q4 2025. So breaking down the GDP, as I mentioned, you can see, start going back a little bit in Q1, we had the negative 0.6% growth, and a large portion of that is that purple bar that's representing net exports. So as we discussed, that's all the businesses that wanted to get ahead of the potential increases in inputs for their products by ordering them ahead of time, basically, to get ahead of those price hikes. So then what we've seen in Q2 and Q3 of last year is that net exports number is shifted. So now it's a contributor to GDP because we're exporting more than we're importing. And then specifically in Q3, you can see that the consumer really roared back. 68% share of nominal GDP was contributed to consumption, which, over the last few years we know, and we've talked about the U.S. growth is really pushed forward by how much the consumer spends in any one year. So going into the consumer itself and what makes up the consumer. Like I said, the healthy consumer is great for the economy, as we just saw, but when we look under the hood, we see that one consumer type is responsible for a large portion of overall spending. When looking at net worth growth, you can see the difference in pre-tax income growth has dramatically increased for the top 20% compared to the gray area, which is the bottom 80% of earners. And it's really since the start of COVID that we've seen this trend start and then continue. Because the 20% possesses more financial assets, they've benefited from the bull run in the stock market that we've seen as well over the last 3 years. And then, as you can see, since the start of 2024, when that spike at the top and the blue happens, it's just dramatically increased over time. And then the top right, you can see the top 20%, which is that last bar. Pre-tax income is just about half of the overall income, and then the spending by the top 20% is about 40%. So again, this smaller 1/5 of the population is really driving the spending portion of the economy, which, as we just saw, is 60% of overall growth for last year. And then again, with consumption, people are usually only spending when they're confident. When people are scared or worried about the economy, they're usually holding back on any spending and just really putting their money towards necessities. So towards the end of last year, with some of the data we saw, the Fed shifting their worry towards the job market side of their mandate, you could say confidence was pretty low. The last reading at the bottom there says January 2026. You can see we start to come up a little bit. Obviously, that was January, and if you've seen the markets over the last couple of days specifically, that number might start to creep back down a little bit. When we break the consumer down, looking at assets versus liabilities, again, almost half of the assets of a consumer, when we're looking at Q3 of last year, is attributed to other financial assets. And of course, like I said, that bucket has just grown over the last few years now with how well markets have done. When we look at the household debt to service ratio, it's held pretty steady. It's at 11.6%. See, it's kind of tapered off and back at the level it was before COVID happened. So nothing alarming there from people being able to pay their debts using their disposable income. And then flow into early delinquencies, kind of the same story. You'll see a slight dip around COVID and then kind of getting back to trend and leveling off. Of course, the orange line looks alarming, but that it's skewed because it's student loans. And if you remember, they're forgiven, not forgiven. You're going to have to pay the full portion. You don't have to pay it. So that back and forth created quite a wonky figure in that chart. But again, things are just kind of normalizing after the dip we saw with COVID. And then actually, we're going to do an early poll question tonight. So what percentage of the 2025 federal budget went towards interest on our debt? So this is what percentage of our overall budget for the fiscal year 2025 was towards an interest payment on our debt. Choices are 10%, 25%, 14%, and 6%. I'll give you guys a couple seconds. All right, so looks like 25% of you said 70%, 20 said 14%, and 10 said 6%. Well, it's not quite that much, but it is 14% of our overall spending for last year. Oops, sorry, let me hide that. I went on to the next slide. For 2025, it was about $970 billion, or 14% of our total spend. That's actually surpassed the amount we spend annually on defense, which, knowing the U.S., obviously we have a very large military presence, the largest in the world. So the fact that we're spending more now on the interest on our debt than defense is pretty alarming, and it's something that we've continuously talked about. On the right is how we're sourcing the financing for this debt. So income taxes, which ticked up a little bit with some of the policy changes that were put in place. But again, the deficit is 25% is being sourced from the deficit, which again makes not only the overall number bigger, but then the interest that we're paying on that debt is just going to make it continue to grow. There is a little bit of good news when you look at top right. Previous webinars, the One Big Beautiful Bill Act and tariffs were projected to increase the rate at which our debt would grow and net interest. Now it's projected that it actually will have no impact at all, or actually push a little towards a surplus with all the tariff and tax revenue that we're collecting. And then same story in the bottom right, this red line projection was up above and beyond. I think it was at 130% projected by 2034, and now it's actually below the initial projection at 115.5%. Again, saying this is better is, I wouldn't say it's necessarily better. The debt is still growing at an unsustainable level, and it's definitely something that, as we've said time and time and again, something that we're going to have to take serious steps to try to tackle and make better. And then this is just showing you kind of plain and same thing, really. Just since the debt ceiling was lifted in June of 2023, so about 2.5 years, we've seen a 7.1 trillion increase in the debt. Slight reprieve again. You see it flattened out a little bit. This is from the initial tariff and income tax revenue, but the growth in debt continues to climb. Again, the high interest isn't doing us any favors. And like we've said, that it's difficult, right? Because politicians are the ones that can really make a change. But of course, these politicians want to get reelected, and nobody wants higher taxes or to cut spending on federal assistance programs, which are two of the things that could really help us make a dent in this deficit. And then again, something that's not helping, spending versus revenue. So you'll see spending at the top, the light green, and then tax revenue at the bottom, the dark green. You can see the slight uptick in tax revenue, but when you see the difference between the two, a slight uptick's just not going to cut it. Under current law, the CBO projects spending will continue to grow faster than revenues over the next decade. Spending rising from about 23.4% to 24% of GDP by 2035, and revenues are only going to rise from 17.1 to 18.3. So that gap's gonna widen. And again, solutions, possibly faster growth through AI, higher taxes, cut spending, but that's going to be hard because Social Security and Medicare costs are only going to go up, and then lower rates, which obviously could cause inflation. And as we've seen, the 10-year, the longer term curve where you try to refinance that debt doesn't really move with what the Fed has been doing. And then the last piece, which I touched on in the overview, the ISM service and manufacturing PMI numbers. So the highest reading for manufacturing since August 2022, and the first expansionary reading in 12 months. There were improvements in new orders, production, and employment, and this is what drove the surprise. It was forecasted at 48.5, so a pretty big surprise there. Obviously, like we say, this is 1 point. We'd much rather look at a trend. So we'll need to see if there's a start of an upward trend on the manufacturing side of the economy. And many are kind of tempering expectations due to January being a reorder month, high reorders in that month historically, and just after the holidays. And some of the buying appears to be getting ahead of more expected price increases due to tariffs. So we'll wait and see over the coming months to get a better idea of the trend. Skip the slide. So artificial intelligence, obviously it's been the hot button topic for a handful of years now, and especially this week we've seen some red the last couple of days because some of these hyperscalers, the front runners of AI, they've been either giving week forward guidance, or the spending on CapEx has been way higher than analysts are expecting. Which leads us to this slide. More firms are pivoting to debt markets to finance AI investment. So initially, when the build out first began, these companies were able to finance most, if not all, their AI spend using cash stockpiles and free cash flow that they generate on a quarterly basis. That's starting to change. We've begun to see a dramatic shift in this trend primarily due to just how much they've already spent, and then on top of that, what they project they will need to spend in the coming years. Right before this call, Amazon released their earnings, and it was projected they would spend 140 billion this year on AI, and they actually upped their estimate to 200 billion. I think Microsoft as well was earlier this week, and I think they doubled their CapEx spend. So as we've seen, and as we're going to continue to see, these are not small numbers, and they're growing at a rapid pace. So as more of these companies take on debt, we just want to be cautious of that, because if they start coming under stress and they're not producing as much cash, they're going to have trouble repaying and making some of those debt payments, which is where they could get into trouble. Like I mentioned, Amazon as well, another big name in the space. Google just reported earnings this week. CapEx was supposed to be at about 175, 185 billion. That was above the 119 estimate and more than double their 2025 spend. And then also Meta expects to spend 115 to 135 billion in 2026. Again, almost double their 2025 figure of 72.2 billion. Many of these companies have stated that the spend is for investment in future projects and to keep up with current demand. Like Google itself saw its cloud unit backlog more than double year over year. And a lot of these companies are saying it's just beginning. So the spending, like I said, is just going to continue to increase. So again, if the revenue matches the spend or obviously outpaces the spend and the spend was worth it, then that's great. The economy can keep growing. These companies can keep chugging along. But if there are hiccups, and like we've seen this week, if the market doesn't agree with some of these decisions that are being made, we could start to see some really volatile days in the market. Moving into the Fed, inflation, and interest rates. So inflation, again, was the focus of the Fed for a long time, especially coming out of COVID. You see that it marks April 2025 when it's about 2.3%. And since then, it's moderated, came up a little, starting to come down. And the last reading as of December was 2.7%. Core PCE, the Fed's preferred inflation measure, is scheduled to come out on February 20th. So that'll be a big day as well. We had a slight decline from November, and like I said, stayed relatively stable since March of last year. And then although it is above the Fed's 2% target that they always mentioned, they did pretty much make a switch at the end of last year to the other side of their dual mandate and pay more. Now they're paying a little bit more attention to the labor market. That's not saying that they're completely ignoring inflation, but even though it's above their target, they're okay with the trend, the progress that they've made, and more importantly, they're kind of starting to become a little bit concerned about the labor market. So speaking of the labor market, December, and again, the data a little wonky because of the shutdown. December added 50,000 jobs versus 73,000 expectation. The January number has been delayed due to the partial shutdown, so that'll come out this Friday. So again, a big potential market moving day there. October was revised down by 68,000, and November was revised down by 8,000. Again, this isn't anything we're not used to. Revisions happen a good amount, actually, and especially as of late, this can be because additional reports are received after the published date. Also, end of the year, there's a lot of seasonal factors that come into play. Overall, for the year, we added 584,000 jobs, which is about 49,000 a month. This is the more alarming part for some people, because outside of the two most recent recessions, that was the slowest job growth since 2003. So that definitely has people worried. And when you look at, end of the year, you can see the top table in the left chart, the 3-month average is technically negative 22,000. And usually when you see negative job growth, that usually means you're in or quickly headed towards recession. Looking at the right side, the right chart, wage growth for December came in at 3.6%, and unemployment ticked down slightly to 4.4%. Both of those numbers above their 30-year averages. The thing that has people a little flustered is the normal relationship between unemployment and hiring has kind of broken. So pre-pandemic, today's hiring rate would usually align with a much higher unemployment. Instead, it appears that firms are cautious after they kind of overhired right after the pandemic. So this doesn't really seem to be primarily about AI or even current policy regarding immigration. That does have some impact, but it really seems like it's more the hiring slowdown began before the policy shifts and before AI adoption really accelerated. So that means the more likely explanation, in our opinion, is that it's more of a post-pandemic normalization after overhiring. And it's not obvious, but the chart kind of paints that picture for you with these, and it's going to be weird looking back in 10, 20 years when all these charts have these crazy up and down in such a short period of time. It's obvious that's from COVID, and we're still dealing with some of the effects and probably haven't seen some for the labor market. So it's overall the labor market, big picture. You can find data to support both optimism and concern. The key is kind of looking at it all together and from a 1,000-foot view, and focusing again on the trends and not one specific data point. So some of the more positive pieces of the job data, while hiring data has been below expectations as of late, there are components that demonstrate the overall health of the job market may not be as bad as as you see in the headlines. The two specific numbers or charts that I want to walk you guys through are wage growth and initial jobless claims. So as I mentioned, wage growth has remained elevated above its long-term average here of 3.14%, signaling that those jobs are seeing increases in their pay. Obviously, higher pay for workers is better. It signals that employers want to keep their employees, and they're increasing pay to ensure that they retain the people that they currently have on payroll. Second, happy piece, positive of all this data is initial jobless claims. So here's the 4-week moving average of initial claims for unemployment insurance. This is probably the most up-to-date data you can get regarding the jobs market, meaning it comes out, weekly. So as you can see, when it ticks up, that's usually a sign of some stress in the market. You can see August 2025 had a scare with the jobs report we had that kind of forced the Fed to switch to the other side of their mandate. But since then, we've come back down below the average. It's ticked up recently from the beginning of the year when we had that downtrend. It continues. It just kind of shows continue to be a low hire, low fire environment. So like I said, people overhired. They don't need to hire anymore, but they don't want to fire anyone. So if we were to see a recession, we'd see this graph spike up well above that long-term average. And then a piece that I'm not sure if it gets talked about enough, it should be top of mind with all the technological advances that are being made with AI and just in general. A more productive economy usually triggers a positive feedback loop. So that usually means lower costs or inflation, better GDP growth, and increased competitiveness. So let's kind of break that down. If it costs less to produce a good, if machines can make it more quicker, less overhead, prices tend to stabilize or even come down, which increases real income because your dollar will go further. You can either buy more of the products and stock up on it, or you can buy that product and then use your surplus of cash to buy something else. For GDP growth, it's higher efficiency. So higher output, you make more with the same amount of resources. And productivity is the primary driver of long-term increases in a nation's standard of living. And then finally, increased competitiveness. So a more productive country can export goods at more attractive prices. So boosting our trade balance. Basically, what we saw on one of those first slides where our net exports is actually contributing to GDP growth. So a part of that could also be contributed to AI, not just the front running that we saw with tariffs. With the productivity increase that's shown on this graph, the U.S., compared to everyone else, a very large percent, that could be contributing to GDP as well, which of course is great for the economy. And on the other hand, it also influences the job market. So short term, obviously we've heard some of this, there's a displacement effect on workers. I don't know why, whenever I hear this, I think of Charlie and the Chocolate Factory, the newer one. Charlie's dad, I believe, works in, I might be making this up, but believe he works in a toothpaste factory where he's screwing the caps on all the toothpaste. And one day he comes in and they let him know he's been fired, and he sees a robot that is screwing the caps on the toothpaste at a much faster rate than Charlie's father was. So that's kind of the first short-term effect that can be felt in the market. When you get this productivity increase, there's a sector shift. So seen during Industrial Revolution, switch from farms to factories. Now you can see that with AI, right? Like instead of manually going through an Excel sheet, manual data entry, some people are being shifted to more strategic roles. And then another byproduct is skill gaps. So jobs don't disappear, but requirements for the job change, and creates a skill gap where workers either need to train more if they want to stay employed. But long term is the compensation effect. So this means it doesn't destroy jobs, it transforms them. Creates new demand, so it lowers prices. So consumers, like I said, consumers have cash to spend elsewhere, which creates entirely new jobs and even industries, and then also can create higher wages. So in a healthy economy, productivity gains are shared, right? Workers become more valuable per hour, and their bargaining power and wages typically rise over time as well. So productivity kind of working in the background. It's not something that's, easily quantifiable really when you see all these headline numbers, but it definitely has a widespread effect through the economy. And, some would argue there are some negatives, but long term, we'd like to think that it's an overall gain for the economy and for the job market as well. So Fed cutting cycle initially started in September 2024 with that 50 basis point cut, and followed with two 25 basis point cuts in November and December of the same year. And then the Fed paused until September of 2025 when the focus, like we've stated, shifted from inflation to full employment. We got a spooky jobs number report. This cut was also followed by two separate 25 basis point cuts to end the year as we continued to get some choppy data. So with keeping the last slide in mind, the first 50-point basis cut came around, you can say halfway between the July 2024 and January 2025, when that pink line really takes a nosedive and the green one starts moving the opposite way. 10-year was at 3.7%, while the 3-month was at 4.48%. If you see now, the 10 is at 4.28%. So it's almost gone up 60 basis points. We started cutting about a year and 4 months ago. So So like we've explained before, the short end follows the Fed, but the longer end contains many factors that are more heavily influenced by the market. Like the term premium for locking, if you're locking up your money for longer, you want to be compensated for that. And then also in the same tune, if the government is running a high deficit and needs to issue a massive supply of these 10-year treasury notes to fund that deficit, people are obviously they're not going to buy them for a low yield. They want to be compensated for the higher risk. They know why you're issuing this debt. They're going to want a higher yield to invest due to concerns, about these high long-term debt levels. So a mixture of that is what we've seen. As the Fed continues to cut, you see that pink line come down pretty in sync with when the cuts happen, and then the green 10-year treasury, which influences, more day-to-day lives, even longer end, mortgage payments, credit card rates, if you want to take out a loan, things like that. So that's why people, cutting hasn't really influenced the consumer as much as maybe we thought it would. And then market expectations for the Fed. So this is looking at the April 2026 meeting. I was parsing through the next couple of Fed meetings, and this one stood out. So currently, the target rate is 350 to 375, which is that bar on the far right. So currently, it's at about a 55% chance that in April, the Fed will pause. It won't do anything. The target rate will stay the same. If you look at the table at the bottom, a week ago, or even a day, February 4th, that chance was 75%. So the odds that the rate is going to remain the same has gone down 20% in one day. And it's filtered over to the 325 to 350 target rate and even the 3 to 325 target rate. So you don't even really need to think about the numbers. You just need to think about that even over the last day, the last week, there's been uncertainty in the market, whether it's the partial shutdown, the weak jobs numbers, the earnings calls that haven't gone as investors would want them to. All this uncertainty is leading people to believe that the Fed may have to continue cutting earlier than we expected even a week ago. And there's another primary reason that maybe some in the market think the Fed may be cutting sooner rather than later. And that has to deal with President Trump's new Fed chair nominee, Kevin Warsh. He was a Fed board governor between 2006 and 2011, so during the great financial crisis. His views: Fed should not have a large balance sheet, so we should let the treasuries that mature, we should let them roll off of the balance sheet. And he's historically hawkish, which means usually elevated interest rates, which is part of quantitative tightening as well. The impact, and I put a little asterisk by this because this is the greatest question with, it probably would have come up with anyone that the president hired, because as we know, the president has been demanding that Fed Chair Powell cut rates for a while now. And he's stayed to his, the Fed's independence and the committee approach. Mr. Warsh has said that they're going to shift toward less data dependency, rely more on the market, and then have a less communicative policy. He did mention that there's no change to independence or committee approach, which I argue is the largest part here. So if you think about it, this system's been in place for a while. There's a reason there's a committee. There's a reason we know how many people disdain. There's a reason that these Fed chairs, talk to Bloomberg and MSNBC. We have a pretty good look into how the Fed operates, and it's pretty hard for any one person to have the complete opposite view of everyone else. And even when people were initially worried about Mr. Warsh coming on because they believed he would just continue to cut every meeting to satisfy the requests of the president, I looked back and I saw this in an article. This is actually a speech he gave in 2010 called An Ode to Independence. And I highlighted what I thought were the important parts. If the Federal Reserve lost its independence, its hard-earned credibility would quickly dissipate. And then below, central bankers, the world over must demonstrate they are worthy of this moment and will be steadfast protectors of our institution's credibility. So he understands that the Fed independence is extremely important, and knows. I don't think he takes what his job and what the committee's job is very lightly. Now we can talk about earnings. So S&P 500 earnings. Again, a chart we've grown familiar with recently, but earnings growth continues to be strong. It came in at 12.6% year over year for the S&P 500 for 2025, well above the average of 7.3 we've seen over the last 24 years. Mainly attributed to the margins that continue to widen, in revenue that remains elevated as well. Earnings have been the main driver of returns in the market for a majority of the bull run that we've seen, and are projected to grow. There's those dark forest green bars in the first chart, projected to grow over the next couple of years, 14% this year, and then 16% in 2027. The problem occurs when you pair the possible earnings disappointments with extremely high valuations. Even as we've seen, and I mentioned Amazon, Google, even these companies who are meeting or even slightly beating estimates, that's just not enough for investors anymore. We're kind of at the point where people are starting to parse through outlooks and other pieces of the company's finance. We mentioned CapEx to see, are they spending the money that they're making on the things that are really going to drive future revenues? And is the AI story going to continue to be part of that? And then again, kind of going to what I just said, despite 81% of S&P 500 companies beating fourth quarter estimates, so this is the last quarter, these stocks, the 81%, have underperformed the index by an average of 1.1 percentage points. This is the worst on record. So I think that kind of, not predicting anything or saying things are changing, but it's kind of a warning sign. And what I mentioned, people are starting to look beyond just the headline numbers and dig deeper into the surface and starting to question more like, how much can we really spend on AI? And are we going to see continued increase in revenues from all this spend? Next, looking at valuations. So valuations, long-term returns, again, something we've continued to stress. Just when you're looking at forward PEs and subsequent 1-year returns or 5-year returns. So the 1-year return on the left, as of February 4th, we're at a 21.9 forward PE on the S&P 500. Generally, that's not a bad return, obviously, compared to the last couple of years. People would say it was bad. But what looks a lot worse is when you look longer term. The chart on the right's 5-year annualized returns. When you start with a 21.9 PE, your return gets drastically lower. So it shows you that when you invest in these high valued, or some argue overvalued companies, you usually realize a longer term return moving forward. And then looking at the S&P valuation itself, so forward P, as I mentioned, 21.9, well over the 17.1 30-year average. Shiller's PE, which is PE adjusted for inflation, even more dramatic at 40.3 compared to a 28.6 30-year average. The dividend yield continues to be low for the S&P, and then the earning yield minus the yield on excuse me, on fixed income is actually negative. So you're not, again, with the dividend yield and the earnings spread, you're not getting compensated for taking on the risk that you're seeing with these elevated price to earnings multiples. Top 10 companies, so the index concentration itself, we actually have seen this number come down a little bit since the last time we spoke. Top 10 was 28.8 and the remaining was 20.7. So those have come down, although as you can see, still 132% and 121% of their average. And the S&P itself is 130% when you combine those two, 130% above its average from a PE perspective. And the weight of the top 10 companies in the S&P, so you can see the weight and the earnings have moved in lockstep since the second half of last year. February 4th, as of yesterday, 39.1%. That's the percentage of the S&P made up by the top 10 in market cap, and they're responsible for almost a third of the earnings in the S&P. So, like we've talked about, if and more likely when things start to shake out, that's when you really have to start worrying about concentration within an index. The concentration in top 10 companies itself, but then when you think about AI as a subject, it impacts all areas of the market. You have it in real estate with people buying plots of land to build data centers, utilities with how we're going to power all of these data centers. So it's really spread across all of the market, and so it's concentrated not only in the S&P 500 but in other indices as well. And this is just data to kind of back up what I was speaking on. So the S&P 500 performance, and then you have it broken down, S&P 493, and then the Mag 7. So the returns, as you can see, like I said, the last couple of years, 2023, 76% for the Mag 7, then 48, then 23. Year to date, -3%. And then you can see same thing for S&P 493, 11%, 14%, 13%, 2%. So we've started to see that broadening that we've talked about that was essentially happen across asset classes, but within concentrated asset classes like the S&P as well. So even though these larger companies, the Mag 7, aren't performing as well, the rest of the market is starting to kind of pick up and catch up. Even though a lot of these hyperscalers are seeing large double-digit losses, you're not seeing that yet in the index. And then earnings growth as well, the bottom left chart. So 2024, pretty drastic difference, 40% to 4%. And then as you can see, 2025, 2026, we're closing that gap a little more between 493 and the Mag 7. And then the chart on the right, I really liked showing the performance dispersion between the 7 companies and then the S&P itself. So 2023, obviously, drastic outperformance by almost all. I think Apple was the lowest, and it's still almost double the S&P 500. Last year, you saw it still come down a little bit. Obviously, NVIDIA way ahead of everyone. And then this 2025 graph is showing you that things are starting to, there's a little more reversion to the mean within the index. 5 of the 7 were actually below the S&P 500's return. And then, the year-to-date graph is not even worth looking at. We're just a year in. But the 2025 graph is showing that we may be at the beginning stages of the rest of the index starting to catch up with the ones that have been, powering us along the last couple of years. And then just looking at all parts of the U.S. market, S&P 500 mid cap and small cap, compared to their 20-year average, it's forward PE ratio, 20-year average. All 3 areas of the domestic equity markets are technically overvalued. Are you mid cap, small cap, are pretty much right at their averages, but as you can see, S&P 500 continues to be pretty drastically elevated in terms of its historical PE ratio. So, big question, how do we navigate? Again, a lot of these charts, and I apologize, a lot of these charts you guys have seen, if you've been on other webinars, you've seen a lot of these a lot, but I think it's even more important that we review them on today's webinar, because a lot of these you're starting to see the shifts that we've said, hey, this hasn't been this way since 1999. You're starting to see some of these shifts actually happen. So this first one, it just has to do with the starting CAPE. So I mentioned the PE ratio adjusted for inflation. The CAPE ratio here, so it's a 40.3, as I mentioned on a previous slide. That puts us in this first decile, which would mean forward 10-year return on the S&P 500 annualized would be 3.1%, which would be extremely low for U.S. large cap equities, especially over a 10-year period. And then small versus large. So all these slides I'm going over, they're going to be about diversification, which is probably the key tenet we stress here at Ironwood from a portfolio perspective. Diversification matters. They're projections by the smartest people in the world, and they can be completely wrong year after year. What's important is making sure you have access to all parts of the market, so that even when one does poorly, there's probably a decent chance that you have things that are zigging when other parts of the market are zagging. That's usually how I describe it, and that's kind of how you want your portfolio to act to protect your wealth. So again, small versus large, like I said, this is one of the things hasn't been this way since 1999, 2000. .com bubble, you can see, is the last time large cap was so highly valued compared to small. But since that point, the beginning of this year, you can see the trend has started to decline. And that's been evident because small cap has outpaced large cap pretty drastically the start of the year. And again, we don't want to focus, it's only been a month, but this could be the start of this long-term trend that we see here in this graph. And then the same kind of breadth, value versus growth. So when the peaks are high, that just means growth is outperforming relative to value. Again, as the note said, another peak is high or just higher than the dot-com bubble era. And again, this is kind of hand in hand with the other slide, because usually small cap stocks are more value tilted stocks. We've seen the beginning of possible reversal in that trend. These rotations are rarely clean and consistent. So we will see, as you can see, over the past year, we'll see a lot of up and down, a lot of volatility, especially with the amount of volatility we've already seen in the beginning of the year. And the rotation is often due to growth stocks getting too expensive, and then investors are flight to safety. I'm sure you've heard the term, because value stocks offer a higher yield during uncertain time, and investors prefer that cash in hand. Again, we've talked about breadth within the S&P. Market breadth is also improving, and actually has been improving if you strip out some of those Mag 7 stocks. Take out NVIDIA, since about the middle of 2025, Japan and Europe have actually both outperformed the US in terms of total return. And then on the right, different global investment themes, you can see US growth is the dark gray line, and it's getting outperformed by some of these other areas of the market that are completely outside of the US. So again, that's why important why we invest, not only in fixed income as ballast, but our equity portfolio should also be diversified overseas and in other markets that might see better growth in the coming years than the US. And this just touches on that again. You can see the far left, the U.S. current, the blue diamond is January 1st. So again, pretty current. And purple is as of yesterday, the current PE, forward PE of the country's market. So U.S. is on the left, again, extremely overvalued. Japan, Eurozone, EM, China, they're slightly overvalued when you look at the 20-year average, but when you compare them to the U.S., they are extremely discounted. And then on the right, it's relative valuations by sector. So if you look at every sector on this list, the MSC ACWI ex-US is selling at a discount compared to the US. So again, there's relative value in other areas of the market, and it might be smart. It is smart to at least look there, especially with such high valuations domestically. I'm sorry, went backwards. And then again, going off that, investing overseas, right? So this is just an updated chart that we've seen. You can see there are usually long periods where either EM outperforms emerging markets or the US outperforms, and they usually happen over long periods of time. So the US has been had been, I should say, outperforming from 2011 to 2004. We may have seen a reversal of that trend with EM drastically outperforming US last year, and so far this year that trend has continued. So next time we talk, we might have another line. We might continue with, or go back and forth with the EM then US, or have the EM continue to outperform on a relative basis. And then spreads remain tight, so you're not getting paid much to hold risky debt right now, which is not necessarily a bad thing, right? Tight spreads will usually only bite you when things go south and those spreads blow out. People, like I said, people start not being able to make good on their debt payments. High yield spreads widen during times of panic and increased volatility. So think 2008, COVID, there was this smaller uptick you can see, not as dramatic on Liberation Day last year. Spread is just the difference between junk bonds and treasury bonds. And again, right now, you're just not getting paid on a relative basis to hold these. The spread between high yield and treasury bonds, you're not getting paid and compensated for the risk that you're taking. And then again, this is just showing more of what I just said. So what I really focus on right here is the chart on the left. It shows the 25-year average in the last 12 months. So high yield, the 25-year average is 2.8% default rate, and over the last 12 months, it's been 2%. So very low relative to its history. And then if you look at the, what we call junk bonds, the triple Cs, it's half. The default rates are half of what the 25-year average is. So part of that could be, maybe there's just more quality in the overall market, and the junk bonds, maybe they need to be renamed. Maybe they aren't actually all junk, but still, from a fundamental perspective, like when you're holding those junk bonds and things go bad, if you're not being already compensated for the risk, why would you take it when you can invest in treasuries that are yielding close to the same number? So it's just something we also want to keep in mind when investing in our portfolios. And then again, this bar on the left, tightest 20% of high yield spreads, so below that 3.6%. And then on the right, widest 20% above 6%. So right now we're at tightest, so we fall into the left column. So this basically means that 5-year forward return on the S&P 500 based on where spreads are right now is supposed to be 2.9%, which kind of falls in line with that earlier graph. I think the number was about 3.1%, but that was even at a 10-year basis. So when you look at both these graphs, they're both, suggesting that in history, when things are this tight and when things are priced for perfection in the equity market and in the bond market, that forward returns are going to be pretty low for the S&P 500. And then fixed income yields, it's showing yield to worst with the little blue diamond. So yield to worst is known as the floor yield. It's basically just a yield you would receive if you bought the bond today and then held it until maturity, or the day, if it's a callable bond, the day it's called. As you can see on the left side, a lot of the high quality stuff, the treasuries, the investment grade corporates, mortgage-backed securities, anything that's got a backing agency, commercial backed, that yield to worst is extremely high compared to its 15-year median. So you're realizing a good amount of yield when you're holding these bonds to maturity. When you look at the right side, there's what's called extended sectors, and a lot of them, high yields, whether it's U.S., Europe, emerging market debt, whether it's dollar denominated or local currency. These are close to their 15-year median, or in one case below, and then leveraged loans is still up and above. But no matter where you look, compared to the charts of the equity markets that we went to, bonds are still, you're still getting paid to hold bonds. And again, bonds tend to have less risk than the equity market. So if we're getting paid about the same when you're looking at a per risk perspective, we want to heavily consider owning a good amount of bonds in your portfolio as well. And again, same chart, just updated, we've seen before. So as of yesterday, a current yield of 4.4% implies a 4.4% 5-year return on the U.S. Ag, which is the bond index that most people use as a benchmark. So again, 4.4% is pretty good for bonds, for being way less risky than equities, especially when you think about the two charts we saw where equities might only be returning 3% over the next 5 to 10 years. And then same thing here, light green, last 10 years, dark green is next 10 years. So you see US, again, these are just projections, so we want to take them with a grain of salt. But based on a lot of factors, you're starting to see it, people rotating out of US markets and into other areas of equities and alternatives, whether it's real estate, commodities, or fixed income like the US Ag. So this is frequency of positive returns. This is from beginning of 1989 to the end of last year, comparing an all stock portfolio in gray to a 60-40 portfolio in the light green. I love this chart because it just, not every one of our clients is invested in a 60-40, but like I said, we're big on diversification here, and I think this screams that diversification works. Sure, an all stock portfolio in the short term probably can recognize a lot higher gains, but if we're worried as a long-term investor, if we're worried about growing our wealth during the good times and then conserving our wealth in the rocky times, I think this paints that picture and shows that diversification really helps with that. And then something I just like always putting at the end is they call it a quilt of returns, asset class returns. It's from 2011 to 2025, and then again they have year to date. And as you can see, just by looking at, you don't even have to read the numbers or the words. By just looking at the colors and where they are in different places across the quilt, it's really hard to get projections right. And it's even harder for an asset class to stay at the top or stay at the bottom or stay in the same spot for multiple years. So again, that's why investing in all of these areas, or a majority of them, putting not searching for the needle, but grabbing the whole haystack. That's kind of the thinking that we want to employ. And with that, I will pass to Preston and see if we have any questions.
Yeah, there's a few. The first question, Is it really bad that these AI companies are taking on debt if they see it will increase their revenues?
Good question. Yes and no. So if they see the revenue, right, and it's a that's even a tough question itself, because like I said, there have been companies that have announced this week that have beat the revenue estimates with the high spend, but it's still not enough for investors. So it's hard to tell exactly one way or the other. But I think I have a slide here. And again, this is not predicting anything, but this chart just shows excessive increases in margin debt have preceded equity bear markets. So the four circles, first one, .com, '08, COVID, and then the last bubble is right now, and saying a warning sign. It's basically just showing the margin debt that is being taken on when it gets this high, historically has not pointed to good times in the S&P 500. So it's just something we want to take note on. Obviously, right now, if it's just being used as finance, like, not a big deal, right? But as I said, if they come under pressure and they run out of money and they can't pay back that debt, that's when we might start seeing some real problems.
And the next question is, what factors are leading people to invest or believe in emerging markets?
So there, excuse me, there are a couple. One, I think, of the graph that we first showed. Sorry, if I'm giving anyone a headache. It usually comes in waves, right? And I know that's not a very analytical answer, but these trends tend to be over long-term periods. It's not just, they don't switch off year to year. And it's usually because there are either technological advances or policy that's in place, or rates. There's a macro trend that's usually pushing the market. And so for a while, it's been the US. Now, with AI kind of coming to a head here in the US, in some of these emerging markets, companies are now starting to pick up on AI and embrace it themselves and see these productivity boosts. Their markets are going to start benefiting at a rate that we've probably already realized here in the US. And because they're at such high discounts, even a small uptick in earnings and GDP, that's going to boost stock market returns for them. Also, if you look at this chart, historically, EM has outperformed in a falling dollar environment. So we've seen that was EM, I think, was up 33% last year. That was and international, not up as much, but up a drastic amount compared to the US. A good amount of that was because the dollar has been falling. It's been going up and down, but for the better part of a year now. And you can see as the dollar falls, both indexes outperform the US and EM by a large amount, which shows you kind of part of the picture of what happened last year. So those are a couple reasons why people are starting to think more about investing in emerging markets.
And last question is, will the tariff revenue that is generated by the United States offset personal taxes soon?
I don't. Short answer, it's going to be hard to tell. I don't believe so. A lot of and something I didn't really touch on a lot because we have talked about it before, the back and forth with the tariffs and them mainly being used as a negotiation tool. I wish I had the slide in the deck, but it shows how high the effective tariff rate was on Liberation Day and where it ended up being today. So that initial inflow of tariff revenue was great. It was a lot of money and it helps push back against that deficit and that interest that we have to pay. But as we negotiate, and you've seen in the news, I think just this week, we lowered India's reciprocal tariff from 25% to 18%, and then you have a lot of the AI importing and exporting we do. Those tariffs don't apply to that because it's considered a crucial part of the economy. And we already have agreements in place with Canada and Mexico where certain inputs tariffs aren't calculated against those. So even though you're seeing the big initial wave of tariffs, a lot of that has become diluted, and even though it's elevated compared to historical levels, it continues to come down as more of these countries come to the table and negotiate with the U.S. And some, it doesn't even take the taco trade or whatever you want to call it. Some of these countries are just waiting, and then eventually the tariffs are either brought down or taken away completely. So long story short, I think that the revenue from the tariffs was a nice initial impact, but I'm not sure long term, as countries start producing in their homeland, that there's going to be that much revenue that continues to come from these tariffs.
All right. Well, thank you, Rex. That's all the questions for today.
Cool. Thank you, Preston. And thank you, everyone, for joining us. I hope that was helpful, especially with the volatility we've seen in the markets. I hope you guys, if you're going to the Open, hope you have a good time there, and we will talk to you next time. Thank you, guys.